In this short video, we will discuss swaps. We will first touch on defining a swap and then move on to the components that make up a fixed for float swap. Our discussion will continue with the uses for this derivative product within the capital markets. A fixed for float swap is a derivative product which can be used as a hedging tool against adverse movements within the capital markets. The components of a swap include a pricing index, such as the Chicago Mercantile Exchange future price, which constitutes the floating price for an interest rate product or currency. A floating price is created from the reference index, the futures price which was just mentioned, by averaging the reference prices over a period of the agreed swap. Floating payments are calculated by multiplying the floating price by the volume of the underlying asset. Similar to a future or a stock, there's a buyer and a seller of a fixed for float swap. One party will pay a fixed price, similar to buying Apple stock at say $600, while the counterparty will receive the fixed price and pay a floating price, the index which we mentioned. Swap pricing periods are periods of time that are agreed upon which incorporate the swap. When the swap period is complete, the floating price is examined and payments are exchanged. If the fixed price is lower than the floating price, the fixed price payer will receive a cash amount or an asset. Generally, monthly periods are used to compute swaps, but quarterly and annual swaps are also used for computation. This does not mean the length of the swap is only a month or a quarter. It just means that after each month, payments are exchanged. For example, two parties can agree upon a fixed for float swap that is 2 years in length. After each month, the swap payments are calculated and payments are exchanged. The average floating price over a swap period is compared to a fixed price to determine which way cash will flow. If the fixed price is lower than the floating price, the fixed price payer receives the difference. The notional quantity is the volume of the commodity used to determine the notional value of the swap. A swap can be created for an investor or hedger that wants to lock in the price of an asset and reduce some of the price volatility associated with the underlying asset. A consumer, for example, might be looking to hedge or lock in his fixed costs of his asset price to protect against higher prices. The consumer wants more predictable cash flows in order to determine their ability to manage expenses over a period of time, say a month. On each date of a swap, a consumer pays a fixed price for an asset multiplied by the volume agreed to per month. The counterparty makes a floating payment based on an arithmetic average of the daily settlement prices of the index chosen. For example, if the CME Eurodollar contract is used as an index, the prompt CME futures contract could be used for each day in the determination period to determine the reference price. Swaps can be used also as a speculative instrument. A swap rate is an interest rate and has a component associated with it in terms of the swap, which lends itself as a slightly different instrument when compared to vanilla futures or the commodities. Many market makers, for example, sell swaps and in turn hedge their exposure with futures, thereby creating swap risk. Swaps are traded in the over-the-counter market. There is an active broker and direct dealer market for swaps on products ranging from interest rate swaps to commodity and currency swaps. Each type of swap is settled differently. The International Swaps Dealers Association, ISDA, is used as a governing body that handles swap issues. ISDA agreements are usually negotiated between counterparties in an effort to describe how settlements will be paid and how disruptive events will be handled. Swaps can settle directly through counterparties that participate within a transaction or through a clearing organization. The Chicago Mercantile Exchange offers swap products which are cleared through its clearinghouse. This will eliminate credit risk. The trades themselves are organized through brokers or counterparties themselves, but are cleared through the CME. And in these cases, margin will be posted similar to the way margins are posted for futures. The Chicago Mercantile Exchange, through its product Clearport, offers fixed for float swaps on many products. The CME determines their settlements to procedures to be the final settlement price for a calendar swap as the cumulative average of the daily settlement prices for the next listed or underlying futures contract during the month immediately preceding the calendar month swap. It changes per product. Swaps are popular and efficient instruments for hedgers to use to protect against adverse downside or upside movements in many markets. Swaps usually cover a range of dates and therefore are geared toward hedging risk exposure.